talk a bit about how the current environment, how that has affected your investment strategy?
Our entire thought process was about investing in companies that, could figure out how to make money at low levels of scale. So we were thinking of investing in companies at single-digit millions or double-digit million valuations, figure out how to put a limited amount of capital into them, and then sell them for a few $100 million to a bank. Like, that was our entire thesis when we entered the FinTech space. I think the narrative has shifted considerably. The art of the possible has now been seen. So the ability to build companies that are billion-dollar, multi-billion-dollar, decacorn-type companies, it's now real. I think outcomes are very different. Ambition is very different. The ability to build companies and not just products has been discovered. So it's a very different investing landscape than it was when we started.
If we go back again 10 years ago, 12 years ago, venture-backed companies didn't raise a lot of money. So they were quite frugal with how they spent their money, and in many cases got their unit economics proven before they raised a lot more money. And then we had for 10 years where companies could raise lots of money, and in many cases, the most valuable, if you raise a lot of money, that signified your value. And I think there's a lot of examples of those unicorns where they're not worth that, and they're in a big mess right now. So I think that question about, is that part of the narrative completely discredited?
To talk about the question of valuations, and the observation I have is that when you look at historical, quarterly data of valuations, they have been adjusting substantially and consecutively for the past several quarters across, mid and later stage deals. But when you look at early stage, and by that I mean the pre-seed and seed, CSA type deals, valuations remain stubbornly high. What's your sense, Ansaf, as to why this is, happening?
Financial services is a large part of GDP, and I think we've just started to scrape the surface of where innovation is happening. And so I think a lot of that has led a lot of excitement to persist even at the early stage, despite what might be happening in terms of growth stage valuations. I think as a venture investor, I think a lot about who is going to be the next buyer of this company. So if we invest at the seed stage, who's buying the Series A or buying the Series B, and trying to think about packaging and helping founders really build a narrative for their subsector of how do we explain what we're doing and how do we value these types of companies. And so I think there is still a lot of excitement and energy and a lot of capital flowing into the early stage, which is driving a lot of this persistence in terms of valuations. But I think a lot of it is driven about the long-term opportunity set within FinTech.
To add to the prior conversation of what's happened and why I think many of these valuations also got so high is you had an understanding that FinTech was part of the infrastructure of many other industries. So the TAM was enormous. So e-commerce goes up, e-commerce adoption goes up, all the infrastructure related to the payment, to the chargeback, to the fraud, to whatever identification that was needed was part of that, was embedded.
If you think about when companies, last, raised, there's a lot of companies that raised in 21, and 2 years later, they're probably very short in cash. Mm-hmm. And my observation is, I haven't yet seen as much small rescue M&A activity, for lack of a better word.
All of this is also an opportunity for a strong company.
Exactly.
If they have cash, if they're in a better position, if they can raise funding, they can acquire some less strong competitors or pieces of technology or teams of engineers at a much lower price than they otherwise could have. And so for the strong companies, they are positioning to take advantage of these opportunities. And then the other piece of advice is, and again, this is common advice, is if you need to raise money, as Luis just said, there's probably a tsunami of companies coming that need to raise money. And you probably want to be at the front of the line versus the back of the line.
I think founders are optimists by nature. That's their superpower, right? And so I think this environment has come fast for a lot of folks. And if you were sitting on a valuation that you were extremely happy and proud of, and now getting M&A offers or bids at things that look a tenth of that price or even more, I think it's just hard for folks to stomach. And so the smart ones, obviously, who can see maybe the writing on the wall, will take advantage of an opportunity earlier than others. But I think many people, the reason why you haven't seen this happen already, I think, is folks who have a bigger belief in terms of where they might be able to head to in the future.
What space, currently are you particularly excited about, and why?
Vertical SaaS within financial services. So I think we see a lot of opportunity both selling to traditional FIs as well as others in terms of how we think about packaging some of those opportunities as well as the multiples we've obviously been seeing in the market with regards to that. So we're excited about investing behind that. And then the second area is a lot in the SMB space. And so if we think about, it's a hard go-to-market, but we think there's a lot of opportunities still available to help businesses who are thinking across the spectrum with regards to financial services.
Where we spent most of our time is fraud, risk, identity, reg tech, and this is, I said identity, but this is all going to flow into this world of identity that generative AI is going to affect, right? And the need in all those categories continues to go up and to the right.
Another area that's very interesting to us is the intersection of FinTech and a vertical. The customization of payments or the customization of lending when there's an intersection is very interesting.
The other one that is early but really big and complicated is data governance, that not even pre-generative AI, like where did this data come from? And in a big complex like within Citigroup, is this data being used in compliance with its license, but also in accordance with the jurisdictional requirements, which are now often state by state, or a vertical requirement like lending, or even your internal like data governance council. Like, how do you prove that and govern that